Welcome to Trillions. I'm Joel Weber.
And I'm Eric Balchunas.
Eric, you sent a note that caught my attention because you were like, it's the wave of the future, manufactured high yield, gonna be a big category. I was like, that's like Eric Balchunas at his finest. Let's unpack those three. The category, a new one, autocallables.
Yeah, I honestly, I'd heard the word a couple times, didn't know what it meant. This is part of a bigger theme that we call Yield 3.0, or manufactured yield. We used to use the meme of the Breaking Bad, where he's in the lab making the meth. Mm-hmm. They are making yield that isn't from like bonds or stocks. They're just making it. And it's very popular, especially if it's a big yield. So autocallables are one of the latest areas that has a big yield, usually 13, 14%, at least in the Calamos ETF that I looked at. And there's a huge demand for this. People love income. I've been to the Money Show several times, especially older people. They just go crazy for income. So these products are quite complicated. In my opinion, I used to say VIX and China were the two most complicated areas of ETFs. This is more complicated. Yeah. So I want to make sure that we understand this and that we could explain it to, our aunt or uncle, like just somebody in our lives.
We're going to try.
But we can't end this podcast until we both understand it. I think I get it, but I get it on a very superficial level. That I just learned it quickly for the note, but I really want to get it, and also want to make sure that people are aware of like the pros and cons of these, because Joel, they're going to grow. This thing came out, this Calamos one already has 400 million, and for something complex to come out, it's pretty good money for that. So I would suspect, and I'm hearing a lot of other issuers are going to launch these, and it's a word I hear when I travel around, including from our index team. They bring up autocallables all the time. So it's a word you're going to hear more and more. Might as well get our heads around it now.
I'm surrounded by papers trying to make sense of this. It's kind of hilarious. I don't think I understand it, so I'll be the litmus test. And to help us make sense of this, we're going to be joined by Matt Kaufman, Global Head of ETFs at Calamos Investments, first to market earlier this year with an ETF in this space. This time on Trillions, autocallables. Matt, welcome to Trillions.
Joel, thanks for having me. Great to be here.
How does this stuff work?
We are going to hopefully get off of the meth analogy.
Yeah, that was...
and we'll move toward...
First step.
Something.
Listen, Matt goes to work every day in like this white suit, and he's in there testing different things.
Right.
Yes.
That's right. That was the Halloween costume this year.
Okay. So
well, you might as well. You already have
the lab
uniform for work.
experiment.
It's
exactly.
not a meth lab, but Calamos came out with a ticker, the CAIE. That's the ticker if you want to look into this more.
That is the ticker,
Tell
the
us how this
Autocallable
works.
Income ETF. So let's take our minds from the equity markets and move it toward the fixed income market. So think like a bond that will pay you a monthly income and return your principal as long as the equity markets don't fall too far. If you can understand that, you can understand an autocallable. So it's a lot like a bond that pays a monthly income and delivers your principal back to you either at maturity or if you're called away early, that is the auto call feature, and it's tied to the equity markets. So bonds are usually tied to duration and credit. This is tied to the equity markets. That's essentially it.
That was a really great way of breaking it down. It's also a quote that you had in the story, Wall Street crams more autocallables into ETFs and race for yield, by our colleagues at Bloomberg News.
Yes.
Matt, though, I got that part. Where does the yield come from? The income? Where am I getting?
Sure.
Where are you getting that income to give to me from?
Yeah, great question. I think one of the easiest ways to think about this is to, normally you would frame it around a covered call. So that covered call space, as Eric was talking about, is a massive market. It's a $150 billion market. I was fortunate enough to be at PowerShares in the early 2000s. We built the first buy right ETF in 2007. I think it was a little before its time. Nobody really bought it back then. Now that space is 160 billion in assets. It's a massive market. And what are you doing with a covered call? You're selling off your upside. It's a buy right strategy. 20 years ago, very few people understood that term. Today, it's commonplace. There's equity premium income strategies. You're selling off upside, collecting an income payment. An autocallable is a long-dated put right strategy. So take the other side of the trade. It's a long-dated say 5-year put right with a call feature, and that's it. That's all you're collecting.
He said what he just said, and he goes, "That's it." Yeah, come on, dude. It's okay.
You said
hold
you
on,
wanted
hold on.
simple, so we're starting simple.
I'm going to break this down. Okay, I have $10,000. I give you $10,000 to this. So first of all, who makes the autocallable? Like, is it a bank? And this is like what, like a swap contract, or like who am I?
Note, right?
Am I doing? It's just like Michael Burry, where I'm walking into Goldman and I say I have this idea, and the bank just says, "Okay, I'll make a thing for you." Is that what we're doing here?
Yeah, so you can't go to the market and you can't go to the listed options market and find an autocallable yield, option. That does not exist. You can go to the listed options markets and do put writing strategies. You can do call writing strategies. But what we've done is we've partnered with JP Morgan.
There you go.
Biggest bank in the world. So yes, it is a bank strategy. You cannot do this with listed options. So we partnered with JP Morgan. We took their autocallable pricing methodology and we built a laddered version of this.
Hold on. What is JP Morgan's autocallable pricing methodology? So first of all, what is the index that we're based? What's the equity index?
Sure. So let me explain this to you in a way that we can understand. So you talked about what happens if you have $10,000. So I brought Monopoly money.
You did. Literally.
I did. Yeah, I actually brought Monopoly money here.
You've done this before.
So we can play with this. So here, Eric, I'll give you $100 Monopoly
you gave him
bill.
10,000. He just gave you 100 back.
Yeah,
I don't know
it's
about
easy.
that.
He would be a bad banker in Monopoly.
It's easier to think about that because it's let's pretend like that $100 is the par amount.
Okay.
Okay. So
By the way, I get nothing. I don't like this game.
you're going to be Joel. You're going to be the market. You're going to be the market here. All right. So Eric's going to buy an autocallable note. I'll be the bank. So you're going to invest in an autocallable note. So give me your $100.
Okay, here's
so
my
you're
100.
sliding it across the table. Okay.
I
Now
got stuck in the middle. I'm going to move it across.
let's
Yeah,
put
we
some.
don't want it in free parking.
Sure. So let's put some terms to this note. Let's say it has a 5-year life. It has a 60% principal coupon barrier. So we're going to pay you monthly income as long as an equity index does not fall by 40%
During what time period?
every month. It's a monthly look.
So in other words, if the S&P, let's just say it's the S&P index, if
Yes.
it doesn't fall 40% in a month,
In a month from
Wow.
the starting date.
so then I get a little something.
Yeah, that's right. And then there's
Okay.
the same thing at maturity. So let's just play this out.
But hold on, does the 40% restart in the second month?
It's from the starting point.
Okay, so
Yeah,
the starting
since
point is right
inception.
now. And let's say the first month the S&P is down 2%. I get paid.
So Joel gets to decide this. He's going to be the market here.
Okay.
Okay. So let's say this pays 12% annualized income every month. So I've got your $100 safe here. So Joel, let's go 30 days in the future. What is the market going to do? Pick a number, up or down.
Right this year, I'm going to say if we're playing this from the beginning of the year, market go up.
Okay. Let's say you're up 5%. So market's up 5% in a month. Eric, you get $1. You're good.
Okay.
You're good. Okay. Next
Okay.
month, let's say the market.
Well,
You
April
pick.
happened.
Okay.
Yeah.
Kind of was a little chaotic.
Okay. Let's say April
Market-
happens.
Let's say market went down.
Market goes down how much?
10%.
10%. All right, Eric, you still get $1. Market's down 10. It's not down 40. It's down 10.
It resets every month.
It's not. It's from the inception of the note
Oh.
to that month.
I see. So because it went up and down, now year to date, what are we down, 6% or something?
We were up 5. Now we're down 10. So down 5 so far.
Yeah, right. So let's just keep playing it out. Let's say the market is down 40% the next month from inception. No dollar for you.
Hold on. Stop real quick. So we're down 5%. So the market would have to go down like another 35%.
Correct.
Then it hits 40% year to date.
Correct.
That month, I don't get $1.
That's correct.
And then because this got called. In other words, the
Nope,
whole
you're
deal.
not getting called yet.
Oh, okay. So I don't get $1.
Correct.
Now the next month it goes up 5%.
Your dollar kicks back in.
I get another $1.
You get $1.
Okay. What if it goes down another 20% from the 40?
Then you do not get your dollar.
Gotcha.
Yes.
So in other words, as long as it doesn't come above the 40% watermark, I get no dollars. If it comes up above the 40% watermark, I start getting my dollars again.
Exactly.
And the 100 you just hold on to.
How is this a good deal for JP Morgan? It seems a little too good. Like I feel like the number should be 10%, and that would be fair for JP Morgan.
Sure. No, that's a good question. So let's keep playing this out. So now you've got your $100 still here.
Yep.
So 5 years from now, let's say the market is down 20%. You are maturing at par. You get your $100 back. If the market is down 40% or more, that's when you have principal at risk. So let's say the market is down 40% 5 years from now. if I could make the sound in the mic, we're going to tear your $100 bill by 40%. You're going to get 60% of your principal back.
Oh,
That
I see.
is the risk that you're taking on.
But he's collected income along the way.
Correct.
If
So
the strategy
Yes.
after 5 years, if I collected $1 every month minus, say, like 5 months, that would be $55 against my 60,
That's
40% that I lost. So I would cushion it a little bit,
That's
like
correct.
a covered call. Okay.
Yes, exactly. Okay,
But-
so that's how a single auto-callable works. The call feature then would be if the market is positive, usually after a non-call period like 1 year, then you are called away. JP gets the money back. You get your principal. You get your $100 back. You get your final coupon payment. Good job. Show's over. Everyone goes home. And you have to go buy a new note. That's how it works.
Wait. That's when it gets called. I thought it got called if it goes down too much. No, when
No.
it goes up.
Correct.
So when does it get called again?
Yeah, so you're getting called when the market is positive after a 1 year
I see.
non-call period.
So if the market's up 7% after, like the market is up this year, it's up 14%. So let's just say
Correct.
the year ended now, we're up 14% in 2025,
Mm-hmm.
and therefore I would get the $100 back,
Correct.
and then I would have my $12 because it never
Correct.
went down below 40.
Exactly.
So I would have. So at that point, the fund would automatically reinvest in a new autocallable.
That's correct.
So now in that getting the $100
So it's like
back,
a big reset.
Well,
is there
right now
any
we're-
loss of money in that $100 getting called back? Or
Not
no,
in this
it just
example.
resets.
Correct.
And you reset it automatically.
Well, so I'm teaching you about an auto-callable. So
Yeah.
we know how the auto-callable works now. So what we have done with CAIE is we've laddered exposure to 52 or more of these. It's a weekly ladder, a laddered portfolio of auto-callables. So now at week 53, if the market's down, you might lose coupon on one,
I see.
but you have 51 others in the portfolio. So it's highly diversified.
Wow. And the answer is, in reality, in this fund, CIAE, it is 40%. That's the number you don't want the market to go down below.
For a severe and sustained time period. That's
Wow.
correct.
Like, what's that mean?
So we built all of this with JP Morgan and Mercube, a custom indexing provider. And this is all built inside of an index that we trade on swap with JP Morgan. So the risk would be a severe sustained market decline that never recovers, and that in 5 years, your auto-callables start to mature below the barrier.
Let's backtest it. What happens if
Yeah.
March 2020 happens? We're back in the pandemic.
Yeah, use my $100. So
Yep.
I put $100 in. Let's say for a year it's fine. So I got $12 back. But then this next year, it's like a 20. Let's say it's a 2008 where the market wasn't even down 40%. It was down 33% or 35% in 2008, right?
So
Let's
you
just say
would've-
it's down 45% that year.
Yeah.
And it stays down. What happens?
So because this is an index, we can look at that history. We go back to 2005, and you would have lost on 2.8% of those auto-callables historically. It would have equated to a 17% principal impairment. That was the only time you would have lost money. Again, you did
Gotcha.
not lose that 40%.
So you didn't lose everything. You lost 17%.
17%. That's
so
correct.
you bet a 17% loss on something that's almost never going to happen because the Fed's going to step in and start buying assets if we go down that low again, probably.
I think you're right.
That's why I don't get. I look.
Yeah, what's in this for JP Morgan?
Yeah, this sounds like genius from your point of view, but it feels like JP Morgan is pretty smart. Like we had them on; they're pretty smart people. I feel like they could almost get you to do this deal at like 15%.
What do you mean?
Like if the market goes down below 15%, that's the threshold. Like going down 40 seems like almost like beyond a tail risk event. I feel like they could do the same deal with you at 15%. Like that would be almost a pretty good deal because I don't even think the market will go down 15% before the government starts buying up assets.
Sure. I think when you're trying to build something with risk management, Calamos is a risk manager. We've been doing this for nearly 50 years. We want to give people the risk managed exposure. We want to give them a high, stable, tax efficient income. If there is a payoff that we are after, it's that. It's high, stable, tax efficient income. So when you take this and ladder it out 52 or more times, you put 40% principal barriers on it, you get this really high, stable, tax efficient income.
Does JP Morgan consider this like issuing a bond on their port where it's a high yield bond, but with this tail risk possibility, therefore, that's why they're giving you a higher yield.
Well, they're issuing the autocallables, so they're the issuer
Yeah.
of the autocallables. So they're going to take a spread on that note. They're going to
I
make
see.
money on the swap that we're trading. So we trade
I see.
SOFR plus 10 basis points. It's much more efficient for JP Morgan to trade swap with us than it is for somebody to go buy a note from JP Morgan, where you tie up all of their balance sheet, tie up all their capital. You got a subordinated debt structure to that note. Whereas here, if you build it synthetically and just trade it on swap, well, 95% of the assets in the ETF are in treasuries. So that money's sitting at State Street, at the custodian. There's no real credit risk from that perspective. And then post Dodd-Frank, JP Morgan has got to pay variation margin on the swap. So the whole structure is nearly 100% collateralized. So go back to 2008, when a couple of banks went under, you're on the hook for a lot of that. Hopefully you get some of your money back if you're a note issuer or if you're a note buyer. Here you don't have that.
Whose money is in collateral? Does JP Morgan get a cut of the interest from the collateral?
No, it's the investor. So we pay JP Morgan SOFR plus 10 basis points.
I see, okay.
They in turn give us the performance of that auto-callable index that we've created.
What's SOFR?
Overnight rate.
So you pay, I see. So they get a little interest from you, plus 10 bips,
Correct.
and they feel like that's what they get out of it,
That's right.
and that balances out the income they have to give you. But they also have this like sort of, fine print that if it goes down for 40%, they really win.
That's right. They're taking the other
Yeah.
side of the trade.
I feel
see.
a little bit like the guy at the craps table that's like,
know.
I'm going to just watch that game play out and see how it goes.
Well, I mean,
here, I'll give
and
you
the yield is 12. If you get $1 a month, that's 12%, but this is like 14%, so it's a little more of a dollar.
The average weighted coupon, which is based on that par amount of your note, is 14.4% right now.
Okay.
So the thing that we did not get into yet, which we have to build a base understanding of autocallables, it's a $100 billion market in the United States, as you alluded to. The structured note world, well, let me back up. The covered call space, we said is a $150 billion market. Derivative income is dominating the ETF landscape. If you go to the other side of the house, the structured note house, derivative income dominates there as well, but it's through the auto call. The auto callable is a $100 billion market in the United States alone, multiples of that globally. People love this type of exposure.
And it's never been in an ETF until this year.
We built
right?
the first ETF, correct.
This is really interesting. When he talks about people wanting income that is derivatives based, if you look at all the flows into income ETFs, that would be equity, including
Which we've talked about before.
that could be dividend ETFs, which are plain vanilla, or these derivative yield 3.0. Over 80% goes into the derivative ones, which again would include the covered call. So this is again, the stock ETFs that pay dividends, like those old school, they're less than 20% of the flows. So this yield 3.0 is taking the lion's share of all the income-seeking money in the equity space. I'm not counting bonds.
But you're talking about since this ETF has come out?
I'm talking about this year. So this ETF came out after this year. So like the thing is, to me, I'm going to put this into a category with JEPI.
Yeah.
This is a little more complex than JEPI, but the covered call space
Also
is
JP
huge
Morgan.
now.
Yeah.
So but because
Here,
that's
I might push back on you a little bit. If you look at equity premium income strategies, again, another JP Morgan, tied product, but JEPI and JEPQ will hold actual equity-linked notes and then deliver you, that income, which is somewhat tax inefficient, but you don't really know what's going on inside those notes. Like you have to look at what they're publishing, which a lot of times they do it late. And so there's not a lot of transparency in those notes.
To be fair to them, though, the yield that you get, like that we display on the DES, is pretty good. I mean, I think what's like 9-10%. And I think to some degree, like some of these products I've seen over the years, you just either trust the issuer or you don't. Because
Correct.
a lot of advisors, they're not going to get what you're selling. They're going to say, Matt, I trust you. You're a good guy. Calamos has a reputation. I also think the target outcome ETFs, the buffers, are also like, I just trust Innovator and Bruce Bond, or I trust BlackRock, because these are very complicated. Yeah. The good news is the ETF industry does have this like really good track record. And from what you're describing, it does seem like a pretty good bet to me. I'm not really seeing anything too outrageous, except the fact that obviously if there's somebody very bearish, this might not be the product for them.
So who who was doing it before the ETF, going to a bank and saying, I want that autocallable thing that you guys have told me about? And then how is that changing now that it's, potentially retail friendly?
You mentioned the buffered ETF, so I had a hand in building those. So if you trust the buffered ETFs, those have been working phenomenally for nearly a decade. It's a very big space now. That model is very commoditized. Everybody who builds buffers tends to do it closely the same way. So yeah, if you understand that space, or that was something that was mildly confusing back then. People had to get their heads around it. It was new. Now it's not. Most people understand it. The same is going to happen with autocalls. It's a new space for ETFs. People are going to wrap their heads around it. They're going to understand it. But what we did with the buffers was largely disruptive to the banks. They did not really appreciate that there were flex options being built around this. It wasn't a bank-driven product. Whereas here, this is collaborative with the banks. We're seeing a tremendous amount of demand to actually bring in those structured note strategies and do that inside the ETF world. That's going to be a massive space. We've opened this huge gate where we can now partner with banks and bring their structured strategies into a liquid, transparent, and ETF wrapper. I'll say that's also tax efficient. So most large banks around the world have an equity derivatives desk. They have an autocallable business. JP Morgan, Morgan Stanley, RBC, like you name it, SocGen, Barclays, they all have these types of products that they issue. And it's on a massive scale, hundreds of billions of dollars. And so we've taken one of the most popular versions, laddered it together, did it in swap form, and did it in a way where we can deliver really high, stable income in a very tax efficient way. Most derivative income products are a little less tax efficient. They'll give you either ordinary income, or they'll give you maybe 60-40 treatment if it's index options. Here, the coupon that we're delivering, about 80 to 90% of it will be treated. Our expectation is that it'll be return of capital. So that will be tax deferred until you sell, and then if you've held for a year, it'll be long-term capital gains.
So his 10,000 spits out this income for the duration, and then you give up whatever the market gains, but you're going to get your principal back.
That's correct.
And at what percentage of the time do you get your principal back when you did the
If you look historically, it would have been 97.2% of the time for our U.S. large cap version. We're launching a NASDAQ version that historically had never breached principal. Yeah. So I know you're saying it sounds too good to be true.
It does.
So the piece that we have not unlocked yet, now that we understand autocalls, is the reference index. So if you just tied this to the S&P 500, you would get a low coupon. You'd get maybe 7-8%, something like that. A little bit over risk-free. If you're familiar with covered call strategies, the income that you collect changes with market parameters. It changes with volatility, interest rates, dividends. So what we have done is we've built an equity index that has been customized for autocallables. So it's an S&P 500 base, and it has a high volatility target. It's a stable vol target of 35%, so that every week when we write a new autocallable inside that index, the volatility is the same. So that's how I can come here confidently and say you're going to get a high stable income, because we've stabilized the parameter inside that options pricing model. I know we're getting really deep, but then when you compile all that together, the vol of the strategy historically has been around 18%.
But what happens in those moments where the volatility spikes?
Then your vol will come down in the vol target. So you mentioned 2020. So I put that on pause for a reason. So in 2020, what was equity market volatility? 60, 70%. So you're at 35. So in that environment, you're defending the barrier. Not only do you now have a 40% barrier, but it's even more powerful because your vol is at 35 while the S&P is at 70.
But in 2020,
Only laughter.
That was like when Eric's quiet that long, he's like, it's like next level.
We've done
gear.
it. We
I mean,
haven't
this
made
is
Eric
as close
quiet.
to like a physics conversation
Yeah.
you can have in like our podcast. This is. I mean, we're about to get into black holes and like dark matter.
No,
soon, I think.
black shoals, not black holes. Yeah.
So, but in 2020, you still got your thing. You still got there was no call. It didn't get called.
Over the last 10 years, you would have gotten every single coupon, and you never would have breached barrier.
So I think this is something, when you go talk to advisors and people about this, it sounds like you're going to get interest, but I'm assuming they put like 2% or 3% of the portfolio. You wouldn't go too crazy. And where do you put it? What do you sell to add this?
This has equity market-like volatility. So think of 52 autocallables like rubber bands that will trade at par, and as the market goes down, the rubber bands will start to stretch. You'll trade at a discount to par. And as long as they don't break, then you're going to snap back to par. Those rubber bands will go back to par. So we want to make sure that people are comfortable with equity market-like volatility.
Yeah.
If you're comfortable with that, you can exchange it for a high, stable, tax-efficient coupon.
So if the markets go down, say, 20%, and you're seeing a discount in these, there's a certain kind of trader who may think that's a
Load
good
the boat.
trade. Yeah. Versus on the flip side, if the market keeps going up, a trader may be like, you know what, let me not buy that right now because it's looking a little pricey. I get it. I mean,
So we have...
let me ask you this. Are these used mostly by buy and hold with a little traders if it gets into a discount? Like, what's the buy and hold trader ratio here for something like this?
It's both. Early adopters, there's more than 10,000 shareholders in CAI right now. That's what we're calling CAIE CAI. A lot of them are financial advisors who use autocallable notes. They say, we've been using these for decades. We get called away after 6 months to a year. We have to go buy a new note. Vol changes on us. The parameters are different. Might not be able to get the same terms. I've got 100 of these things on the books, one for every different client. I can't keep it all straight. One advisor that we were talking to said, I go to New York every quarter, meet with the banks, find good products. He said, I'm canceling my flights to New York. I've got this ETF gives me what I'm looking for. It's an evergreen solution. I'm going to play golf. This makes things easy for me.
Where does he live?
He's out west.
Yeah, that's a long flight.
It is a long haul.
Yeah, well, this is what ETFs do, Joel. They take complicated, messy, institutional type stuff and they just make it simple, fast, good, cheap.
Okay, so fast, good, cheap. How do you? What color of light do you give this?
We do
in your
it every
stoplight,
quarter. I don't know
Bloomberg
if we've
Intelligence
addressed this
stoplight
one
formula?
yet. I think
Hold on. What do you give covered call ETFs? What light do they get?
I gotta look. I believe they're green. They might get dinged once for using derivatives.
Okay.
So maybe you'd be the same. Green, but one little note for like the fact that it uses derivatives.
Yeah.
But I guess that's it. I mean, there's no leverage.
The ETF is not leveraged.
There's no rolling of commodities, and there's no hidden fees.
Correct.
Those would be the things we ding them. But I'd have to look deeper. But I would, to me, these feel, between PG and PG-13, somewhere in there.
So the risk really is I'm not going to get my principal back if there's some, real big downturn, or I'm going to give up some upside.
Yeah, your risk is largely to
In
the
favor of
upside as
income.
well.
Here's what I don't get. Like, if I'm in the VU, right, I'm S&P 500, and I get, I know why. You don't get the return of the index. You just
Right.
get the...
Yeah, you get because
Yeah.
the principal just comes back.
Yeah, so in the end, VU could be up 20%. That would outperform this. This is more like just getting a little income based on VU not going down a super amount, which I feel like is a... So in other words, this would be kind of a little less risky than VU in a way.
At times it could be.
Forget volatility.
Yeah. If
Because
you're looking for income,
Yeah.
or if you don't think the market's going up 14.5% next year, then this would be a way to essentially lock that in as long as you're not going to fall by that barrier amount.
So maybe instead of buying a rental property, real estate property, like this is in that category if you're thinking about it from like what a financial advisor would tell a client.
Yeah, that's an interesting way to think about it.
Here it is, Joel. It's a rental property in Florida. But you just got to pray there's not that once every 10-year hurricane. That's
Okay.
what it is.
It is. You are
got it.
kind of like that. Yeah. So let's pretend like you are the insurer, and you are collecting premiums from people all over the country.
It was way more fun when we were doing it our way. I'm an insurer.
I think we nailed it, and that's... I don't think you can improve on it.
Play it out, though.
No, I'd say if you're an insurer, you're collecting premiums. Maybe there's a storm in Florida, but everyone else is still paying you.
Yeah, but aren't you doing these 50 or so all on equity indexes, right? I mean,
Yes.
if one of them's
By the
down
way,
40, they're all down
insurers
40.
got out of
Yeah,
Florida.
but there's 52
because you're
different
laddering
starting
them
points.
when the starting points. You're right.
Exactly.
I see. Oh, I see. Okay, so it's like all over the country, but there's one hurricane in Miami. Okay,
Correct. You're diversified by
Yeah.
time instead of geography.
that's a lot of work.
Yeah.
Like, do you have like associates that like do all this, like keep up Kai? Does Kai take like an army of people, like putting these new notes on? Like, just seems like a lot of effort.
The beauty of Kai is that it's all swap based. So we built everything.
JP Morgan does the rest. It's all on them.
Well, we built everything inside that Mercube index. And so
Mercube.
yeah,
God,
exactly.
that sounds like Matrix or something, doesn't it? That sounds like that sounds too much.
It's
Yeah.
the strategy
Mercube.
at the
Who is that?
at the
Somebody's
craft
last
table.
name?
Mercube is an indexing provider that was
Okay.
founded by the former head of custom indexing at S&P.
The Mercube theory.
Okay, so you're not alone anymore, right? You got Kai was out there first. You
Yes.
got some competition. What does the competition look like?
Can I back up for 30
yeah.
seconds?
Yes,
I know
yes,
we're going to
yes.
spend a while on this. So on the ETF side, the last point here, because we did this index-based, it trades extremely tight. We don't have to post Greeks to the website. There's not a lot of active management here. So we take this index.
By Greeks, by the way, Joel, he doesn't mean Athanasios. He means like formulas, like Vega
That's
and
right,
Gamma
yeah.
and stuff.
Or, Calamos
Just
is
letting
very
him know,
Greek as well.
Because he's picturing Athanasios and John Stamos on your website, and that's not true.
That's right, not yet. We do have Giannis, though. Yeah, so where was I? We take that index, we give that price, almost like an intraday NAV, to the market makers. So they are very tight to that index level. JP Morgan is trading swap on the index. It is trading at 1 to 3 cents wide every day. And that's largely because of that index. So it's extremely operationally light.
Okay, now my question.
Yes. Oh, yes.
You were first. Now there's some competition.
Yes.
How do you feel about the competition?
I think it's great. Competition is good for the market. It's going to grow. We're not going to raise, $100 billion all by ourselves. I hope we do, but I know it's going to be because a rising tide is lifting all boats. If there's an encouragement, I hope that it's done correctly. The covered call space took 15, 20 years to grow and then become more risky. You've got weekly, daily, single stock. My fear is the auto call space does that too fast. And you go into this risky stuff, and then people get hurt and they get burned. And they're like, I thought I had a barrier. I was tied to a single stock. It went down fast. That's what we don't want.
Oh, yeah, because somebody filed for single stock autocallables.
Granite shares.
Yeah.
A lot of them
Which-
too.
I see. So I know you don't do those, but like, let's say you're doing NVIDIA. Let's say you did NVIDIA, single stock autocallable. What would the barrier be, you think?
Well, the volatility would be, fairly high.
Higher.
But it comes at
So
a cost.
would the barrier be 60?
It depends.
Okay.
You can pull those levers and
Yeah.
change your coupon
So what
amounts.
you're worried about is somebody going for the jacked up yield with a lower barrier and people being like not understanding the autocallable.
Correct.
Yeah.
And
I
then,
hear you.
and then it taints the whole category.
And you know
right.
the industry is going to do this.
And you
They
see it.
like to push the envelope.
Oh, for sure. And we've seen this in Korea. We've seen this in other markets where folks.
These are big in South Korea. I know it.
Extremely.
They
Extremely.
love-
They love risk.
They love risk over
So the
there.
Calamos strategy,
Joel,
though, is
the
instead of
degen per capita in South Korea is like off the charts.
the Calamos strategy is we're just going to go to indexes, S&P 500, NASDAQ.
Yeah, let's build an index
Yeah.
that is customized for autocallables to give you the best chance of getting a high, stable, tax-efficient coupon.
By the way, do you talk to Bruce Bond regularly?
I haven't
talked
talked to
to him
him in
about
a while about this strategy.
Yeah, I feel like he's eyeing this. I don't know. I just feel like this is Bruce Bondish.
Oh, that's funny. Innovator brought out some.
Or First Trust. I feel like they might just like.
So we all filed around the same time.
Okay.
Innovator brought out some single stock products. I don't know how well those have done. I'll let you do the research on that. And then the other competitors have not come to market yet. There's about 4 or 5 in the market.
So
But you know why you probably feel that way is because,
you guys all live in the same town in Wheaton, Illinois.
well, this is true.
Like, by the way, in Wheaton, like where he lives, he has like a cul-de-sac. His next door neighbor is Innovator, and then his other next door neighbor is First Trust.
Is that true?
And all their kids are friends, but they hate each other at work.
Is that true? It's all-
Something like
Well, we
that.
don't hate each other.
Okay, all right.
But-
just competitive.
Frenemies.
Yeah. Are you on the same kids' baseball teams?
It is a small town. Well, we have 7 kids, so there's a good chance that we're on everybody's baseball team.
All right.
You have 7 kids?
We do.
Wow.
Yeah, we do.
Oh my
Keeps
God.
it going.
Wow, that must be wow. You look pretty good for 7 kids.
I might.
I don't
need to-
sit down. You just got to keep on going. you know?
Yeah, yeah, that's your exercise, I guess.
Yeah. But I think the
That's
reason
amazing.
I think the reason you're thinking that way is, the buffers at the time replicated the largest structured note market. And in a zero rate environment, buffers were the king. When rates rose to 5%, what are people doing? They're buying fixed index annuities. They're buying capital protected notes. So that was what we brought at Calamos, the 100% protected products. I helped Bruce build Innovator when I was at Milliman. I was there for 12 years. So what are people doing now? They want income. Rates are coming back down. They're chasing that, high stable income. The 40-year run in bonds is over. You cannot get ballast and income from bonds anymore, and so they're parsing it out. And so the auto call space was always the golden goose. We happened to win the race this time.
Yeah, no, Matt comes from that world. This is organic because I've known him for quite a while, and his work on the early days of the target outcome, having worked in an options industry. But what you will find is a lot of the issuers who don't normally do this are going to get involved. It's just the way it goes. But it is. I also think ETFs. Everybody who's seen The Big Short and they remember Michael Burry going over to Goldman and J.P. Morgan and being like, "I want to make this specific bet against the housing market." And at first, J.P. Morgan, they're like laughing at him. They're like, "No problem."
Yeah.
That idea of a swap contract with a bank, people don't realize like the leverage ETFs. Like so many ETFs are basically just democratizing what you saw in The Big Short, and that's kind of cool. As long as it's done responsibly, obviously. Some of the leverage that they're trying to file is 5x, where you're going to get like irresponsible. But for the most part, those 2 guys who are waiting in the lobby of J.P. Morgan at the beginning of this is what Matt has access to those desks that those guys were trying to get access to. These are just customized contracts with a big bank. It's almost like a high roller at a casino who can get a special table.
Yeah, and I'm at that special table just watching it happen.
I know. Now you can just get
For $25, that can be.
that can be me.
Let me ask you this. You have 7 kids. You have other family members. Would you feel safe putting your own family in here, or is this more for a sophisticated investor?
No, I would. What we've done here, going all the way back to the beginning, if you tie all of your money or tie your money to a single autocallable, you have single point coupon risk, single point maturity risk, where you can lose 40% or more of your money. When you ladder that out 52 or more times and do it weekly, now you've got an opportunity to diversify out that risk. You've got a product that looks a lot like the equity markets, but delivers that high stable coupon. So, I own this in my account, not to create suitability. My parents, are doing similar. They own a lot of buffers. They own this for income. When you can tie your money to the equity markets, now you can keep pace with inflation. You can do remarkably better than your fixed income, which would be inversely correlated to inflation. So there's a lot of ways to think about it.
Last time we talked about this space, boomer candy was the phrase that came out of your mouth. Is this boomer candy?
Yeah. I mean, I think so because it's a way to participate. Boomers love income. But then again, so do the Gen Zers too. So I would say the only thing that doesn't make this boomer candy is that there isn't a protection element. I mean, you're betting the market won't go down 40%. And that actual income can be a buffer if it does go down. But I think I don't know, it might be like half boomer candy. I consider boomer candy something that like helps you sleep at night and cures anxiety. This is maybe
boomer candy.
Maybe, or I don't know. It's ancillary, but I could see this appealing, especially like guy from Texas who's a YouTube star. I could see the other younger investors actually getting into this because it does have that's a pretty big yield. I mean, that's going to excite some people. Although some of the yield max yield like 80 to 100%. But with those, you're giving up so much total return.
What makes me nervous with those? Well, so if I remember correctly, you came up with the boomer candy term after we launched the 100% protected ETFs.
Yeah. Well, it was that. I can't remember when I came up with it, but it was that. It was the buffers combined with the cover calls.
Yes.
Those are both. I don't know. They just feel.
It has
like,
a specific protection amount.
Yes.
Here, you're taking on.
It's diet market.
Correct. Here, you're taking on tail risk. So there's a chance some of those coupons
That's why
turn
it's a
off,
little
which
different.
I would agree with you. You've got to be comfortable with equity market like volatility. The single stock covered call ETFs, as a risk manager, coming from an actuarial consulting firm, not something we would build. Calamos is a 45-year-old risk manager. We would not build those. But the yield that those are stating is not a yield that you will likely get. If it's a daily buy right or a weekly buy right, they'll take that number that they've collected and they'll annualize it. So if it's a daily buy right and the market's volatile, well, I'm going to get a good coupon today. And now times that by 252 trading days, and it looks like this massive number. The odds of you actually achieving that are next to zero.
All right, Matt, I have one final question for you, which is, what is your favorite ETF ticker other than any of your own?
Oh, that's a good question. A PowerShares product, I don't work there anymore. We launched food and beverage ETF. Eric, do you remember the ticker?
PBJ.
There you go.
Yeah,
That is a good one.
Yeah.
No one's ever picked it, and it really PBJ
Little
for food and
protein,
beverage. I know.
Healthy fats.
Yeah,
Nice kicker.
that's a good one.
PBJ. Matt Kaufman, thanks so much for joining us on Trillions.
Thanks for having me.
Thanks for listening to Trillions. Until next time, you can find us on the Bloomberg Terminal, Bloomberg.com, Apple Podcasts, Spotify, or wherever else you like to listen. We'd love to hear from you. Hit us up on social. I'm at Joel Weber Show. He's at Eric Balchinas. Trillions is produced by Magnus Henriksen. Sage Bauman is the head of Bloomberg Podcasts.